Welcome to Scarabree's three-part series on startup finance. My name is Steve Perry. I'm the principal in the firm, and we're really intending this three-part series to give you a sense about the options and the alternatives to finance your company, with the ultimate objective being preservation of founder capital. Really critical point, the thing that we think is often overlooked in terms of choosing financing sources. Keeping control and ownership of your business as you go through the many rounds of finance it will probably take to get to an ultimate exit. A little background on me. I think this will be helpful in terms of understanding my perspectives on startup finance. I'm originally a geologist. I spent the first half of my career doing mineral exploration and working with mineral exploration startups in both in Canada and internationally. These companies are largely financed through the Canadian public venture exchanges. These are pre-revenue businesses that really operate in many ways the same way a technology startup operates. In the second half of my career, I was a venture capitalist working in Southern California on clean tech and technology transactions. That work gave me a good sense about the venture capital method of funding startups, which contrasts quite significantly with how Canadian companies tend to be funded. With that brief introduction to me, let's dig into the marketplace. Let's start with the concept of the unicorn company, because ultimately this is one of the genres, or one of the ideas that really drives the marketplace in venture. The concept is that you can have a company that will go from basically a raw idea to $1 billion enterprise in a relatively short period of time. This is a rarity, to be sure, but it's what drives venture capital returns. Let's talk a little bit about just how rare those companies are. I'm going to show you a series of graphs and charts that may help to verify some of this. Initially, in the last 10 years, there have been roughly 140 unicorn companies funded through the venture capital model. That's very impressive, but when you consider that comes from a universe of roughly 400,000 startups, you can get a sense this is a very, very low probability event. How low? Well, that's about the same odds, about 0.35%, as being hit by lightning. So one of the really critical things that you as a founder have to decide early on when you seek capital, are you funding an idea that you are absolutely convinced has that unicorn capability, or are you more likely to have a smaller exit? And the reason I bring this up and why it's so important, you can imagine that in your career, if you have 2 or 3 or 4 wins where you build and sell a business for $100 million and keep 50% of the equity each time, you're going to do very well indeed. And are you really willing to parlay that type of an opportunity in place of going for the $1 billion win, where you are likely going to have less equity at the end of the day? It's a very fundamental question, and it should drive a lot of your thinking about which kind of finance you use going forward. Let me provide a little background on the venture capital structure that you'll be dealing with in terms of funding through the VC network. A typical venture capital firm is a limited partnership. It includes a general partner. These are the investors that actually make the investments. You'll probably deal with one lead investor, one member of that partnership in with your company. That partnership is an investment committee that makes the decisions on the investments. They get their capital from other investors known as limited partners, who have no responsibility for the decision making but provide the capital. That structure overall is built around a 10-year fund, which means the VC has to invest and return the capital to his partnership over the course of about a 10-year period. He may have a year or two of leeway on that, but that's basically the formula. That means he has to deploy capital quickly and return it over a relatively short period of time. That's very different than a public market transaction, which is effectively permanent capital. The shares trade on an exchange. Therefore, there's no need to return capital on a given or specific date. Each venture capital firm is compensated both at the GP level for its work and on the basis of the return it makes off the fund. That's known as the 2 and 20 formula typically, which means the VC general partner takes about 2% of the capital each year to fund operations and receives 20%, the other half of the 2 and 20, from the profits on those investments. That's the basic model. This next chart tells you the challenge for the venture capitalist. Roughly 65% of all deals, about 2/3 of all deals, fail to return capital. That's because we're investing, or the VC is investing in very early stage companies typically that have a high failure rate. Those small number of deals, those unicorns and other highly profitable investments that exit for high multiples, that's what drives the return. This is the fundamental nature of the venture capital bet. You're investing on the basis of your ability to understand and manage risk and pick those few number of companies that will have very, very high and extraordinary returns. The way that plays out over the life of a fund is something like this. You'll see that the typical fund is trying to return about 2x its capital over the lifetime of the fund, and that varies from year to year. More importantly to the investor, the top 10 percentile, top 10% of venture capital funds return something closer to 4x that money. And in fact, if you look at the long-term historical records, a very select number of funds tend to do this rather repeatedly. And that's what drives interest on the part of the limited partner investing community. But as with all good stories, there are always some storm clouds out there. And let's go through a few of those. Number one, exit times are getting longer. It's taking longer and longer to actually get a company from initial investment to exit. In a 10-year fund, that's actually a very big deal. That shows up another way. The actual returns divided by investments are actually starting to show signs of deterioration. In other words, to get that 2x return, more and more value is being concentrated on fewer and fewer deals. Another way of saying that is to say that the number of deals you have to do for an exit is becoming larger. In other words, more of that money is in those few successful wins. And that number is now up around 10, so 10 deals per exit. You can imagine the level of concentration of risk that relates or creates for the VC. And as a result, returns tend to be concentrated in a small number of funds. That's back to that top 10% fund graph we showed earlier. So here you'll see that that average number means that most companies, most venture firms are not actually making that return. When you go back to that 2 and 20 model, that means those 2% being taken out, those returns being taken out of the bank of capital being raised from all of the ones that don't make the grade are having to be offset by the few that do. And that means that VCs have to find ways to offset their risk to account for some of those very skewed return characteristics. So the question now is, how does a VC offset his risk to account for that skewed data population? And that is done with a thing known as the preferred share structure. So today, as a founder of your business, you likely own common shares. If you look at public companies, with the exception of dividend-bearing stocks, most companies are based on common shares. The venture capital model uses preferred shares, which sit preferentially above the common stock. The idea is that that share has certain rights and privileges that allow him control and allow him to take a bigger share of the profit under most conditions. Now let's move on to the next step and talk a little bit about debt. And I'm really talking here about secured debt, the idea that you're borrowing money at probably a relatively low interest rate, relative to the very expensive forms of capital we just talked about, but where you're agreeing to take on security, which means the investor has the ability to take the company effectively and sell it at his time of choosing and pay back his capital. That structure is, by its nature, adversarial. In other words, it's putting you on the other side of the table. You have very different interests from the lender. You have to remember that the lender, your risks haven't changed. The lender is simply finding a different way to get paid for those risks, where the VC is attempting to build in provisions like preferences to get his money back on an upside case or on a neutral case. The lender is trying to make sure that at the first sign of trouble, he has the ability to take his capital back and protect his loss. They focus on what's known as loan loss provision, percentage of deals that fail in their portfolio. This is a very different model. It's intended to have the same outcome in terms of reaching a return by just reducing the risk by having those abilities to sell the business. So this is, in my opinion, for early stage startups, taking on debt, even with that very compelling low interest rate and the promise of a no principal repayment for several years, it still puts you at risk of loss of control. It's very, very perilous to your business and something that management really should think twice about if there are other alternatives. I want to sort of summarize now some critical conclusions. First is both venture capital and secured debt have control and value issues for the founder. You give up a lot for those forms of capital. Second, the grand slam nature of venture, the fact that you need unicorns in a portfolio to make a positive return, leaves you with limited capability to offset those losses, and therefore you apply terms within the preferred share structure or within the loan offset those risks, and those all come out of the pocket of the founder. Finally, I have to say that secured debt tends to emphasize the preservation of capital, what's known as a loan loss ratio, rather than the future success of the business. It's really based on an adversarial process or conclusion. And so we're going to wrap up this section with what I'll call the billion-dollar questions. Why, given a choice, why would you ever give up priority to funders, people providing you with capital and control over your ownership if you had a choice? Why would we ever do that? And two, this will be the subject of part 2 of this series, are there better ways to finance your company? Thanks for joining me today, and I look forward to talking to you further on part 2 of the series.